Good morning. This is Gary DeWall, and this is Bridging the Week, November 11th to 15th, and today is November 18th. The biggest story last week came not from a regulator or a courtroom, but from a consortium of 4 self-regulators and industry organizations that released a study on the feasibility of adopting an insurance regime to protect customers trading futures with U.S. Futures Commission merchants. The bottom line? Only one model appears feasible on a cost-benefit basis, but even that model appears difficult to implement. But there are many other important regulatory developments too, mostly coming from the CFTC in the US, but also from Canada and Europe also. Let's get started. On Friday last week, a consortium of 4 self-regulators and industry organizations released a long-anticipated report on the possibility of adopting an insurance regime to protect customers trading futures with U.S. futures brokers. The CME Group, the Futures Industry Association, the Institute for Financial Markets, and the National Futures Association commissioned the study in November 2012 following the collapse of MF Global and Peregrine Financial Group. The study reviewed 4 scenarios for providing customer asset protection insurance resulting from the failure of FCMs and estimated the potential costs of the 2 most feasible models. One where FCMs voluntarily participate in a self-insurance scheme backed mostly by reinsurance, and the other where insurance is provided to all customers of all FCMs under a government-backed scheme, much like that provided by the Securities Investor Protection Corporation for the U.S. securities industry. Under the captive insurance scheme, FCMs voluntarily would participate with a specially created company. The FCM-created self-insurance company initially would cover up to $300 million of claims by the participating FCMs, with the first $50 million of losses paid by the participating FCMs, and the next $250 million being paid by a group of insurance companies. Payouts would be limited to $50 million per FCM, and according to a consortium of 8 insurance companies, would cost an estimated $18 to $27 million annually, subject to further refinement and negotiation. That money would be for premiums. These costs might be passed on by FCMs to their customers based on their assets on deposit. Participating FCMs would be subject to minimum standards regarding their risk management and internal controls, as well as other matters. That being said, each FCM involved with this FCM self-insurance company effectively would be underwriting the risk of other FCMs in the consortium in connection with its own obligation to fund a portion of the first level of potential losses. In other words, customers' fellow customer risk at their FCM effectively would be replaced by FCMs assuming a new fellow FCM risk, or even worse, unknown customers at a fellow FCM's risk. I'd be helping my competitor. Gotta think about that. Under the SIPC type plan, customers at FCMs would be protected up to $250,000 against the failure of their FCM. This program would be funded by a small annual assessment on each FCM's gross revenue. However, the study estimates it would take, quote, 54 years to achieve the target funding level of $2.5 billion. As a result, to work, the program would likely require government involvement, at least on an interim basis potentially, to fund any gap in need versus resources in case of an FCM's failure. Frankly, it's unclear what the appetite of Congress would be to authorize this type of investment in the current environment in Washington, D.C. But who knows? So much is being done in Washington, D.C. these days. Maybe another initiative is exactly what's needed. Last week, the U.S. Commodity Futures Trading Commission adopted final rules aimed at ensuring that systematically important designated clearinghouses under its jurisdiction continue to meet international standards so that international banks clearing derivative trades through them are subject to lower capital charges. These CFTC rules address governance, risk management, credit risk, margin, liquidity risk, money settlements, segregation and portability, and operational risk, among other matters. During August 2013, you may recall, the CFTC adopted final rules to conform with international requirements that require systematically important clearing organizations, 1, to maintain sufficient resources to meet their financial obligations to their clearing members, despite the default of 2 clearing members creating the largest combined financial exposure. 2, to assess their available financial resources available to meet their financial obligations in such a scenario without using their assessment powers. And 3, to maintain business continuity plans that enable them to recover their operations and resume daily processing, clearing, and settlement within 2 hours of any disruption. The current new CFTC final rules endeavor to plug holes in international requirements that the Commission says were not addressed in its August 2013 adopted rules. In connection with its originally proposed rules in August 2013, the CFTC had controversially suggested that general obligations of a sovereign nature, such as U.S. Treasury securities held by a SITCO or a systematically important clearing organization, to meet its liquidity resource requirements, must be subject to prearranged and highly reliable funding resources. The Chicago Mercantile Exchange, among others, had argued that if adopted, this requirement would mandate it to limit the amount of U.S. Treasury securities a clearing member could post to meet initial margin and guarantee fund obligations. However, the CFTC adopted its proposed rules with only some modifications. This might be interesting to see how the clearinghouses react. The CFTC's new rules are mandatorily applicable only to the Chicago Mercantile Exchange and ICE Clear Credit. Other DCOs may voluntarily agree to comply with these new rules, however. The CFTC claims adherence to these rules will enable a designated clearing organization to qualify as a so-called qualified clearinghouse under Basel capital requirements, or a QCCP. According to the CFTC, the consequences to a clearinghouse that does not qualify as a qualified CCP can be horrific. And briefly, financial regulators in 3 Canadian provinces published harmonized rules requiring the reporting of derivatives transactions to trade repositories beginning July 2nd of next year. The 3 impacted provinces are Manitoba, Ontario, and Quebec. These requirements will not apply to certain foreign exchange contracts or exchange-traded derivatives. The CFTC issued 2 catch-all guidance to swap execution facilities last week. One addressed restrictions on open access, while the other related to registration requirements, the use of proprietary data collected from its market participants, and reporting requirements, among other matters. There are some important matters in these releases. Check out the article version of Bridging the Week for details. The CFTC also issued an advisory that non-U.S. swap dealers that regularly rely on U.S.-based personnel or agents to arrange, negotiate, or execute swaps with non-U.S. persons must comply with U.S. transaction level requirements in connection with such activity. You will recall that transaction level requirements address mandatory clearing and swap processing, margining and segregation for uncleared swaps, mandatory trade execution, swap trading relationship documentation, real-time reporting, trade confirmation, daily trading records, and external business conduct standards, among other matters. And finally, the European Securities and Market Authority updated its periodically published questions and answers related to the rollout of the European Market Infrastructure Regulation, or EMIR as it's more commonly called. Among other things, it addressed whether non-EU clearing members of EU clearinghouses are required to comply with EMIR's individual segregated accounts requirements. By the way, the answer is yes, for EU clients, that is. And whether EU clearing members of non-EU CCPs are required to comply with EMIR individual segregated account requirements when EU clients trade such non-EU CCPs. The answer for that is no. Well, that's it for this week. I've got to go and check my insurance policies. I don't know about you. This has been Gary DeWaal, and this has been Bridging the Week. Thanks for watching or listening, and I'll visit you again next week. Have a great week.